Last Friday, the Chancellor Kwasi Kwarteng announced a big bundle of tax cuts for high earners, cuts for corporation tax and an energy price guarantee. This is set to cause UK borrowing to surge in the coming years. This year alone, borrowing is expected to rise from 90 billion to 190 billion, an unprecedented amount in peacetime. The market response has been concerning, with gilt yields rising as investors sell UK bonds. Sterling has been sliding, and the US Treasury Secretary Larry Summers has likened the UK to an emerging economy. The IFS has stated that the UK debt is now on an unsustainable path, with borrowing set to surge by over £400 billion in the coming years. Given all these negative news we're seeing, with sterling falling, gilt rising, is the UK at risk of a debt crisis? Well, in the sense of a classical debt crisis where government defaults, like in the case of, say, Argentina, the answer is no, at least in the short and medium term. But that doesn't mean to say there aren't very serious implications of this budget for worsening the standards of living in the UK and putting pressure on inflation and putting pressure on future government spending. So first of all, why the UK will not face a debt crisis. So first of all, although gilt yields have been surging since the announcement, they are still relatively low by historical standards. You can see in the early 90s, gilt yields were around double figures. So there's still a long way to go. Secondly, debt maturity on UK debt is quite a long time. It's around 15 or 16 years. So that means the UK is not at risk of a sudden crunch. Thirdly, as many people do state, especially modern monetary theorists, that the UK with its own currency and own central bank is always able to buy government debt by creating money. The Bank of England acts as a lender of last resort. So if the market was unwilling to buy UK debt, the Bank of England could step in. Now, of course, this is severely curtailed by the inflation we have at the moment, but at least in theory, you can avoid a technical default by the Bank of England buying debt like they did after the great financial crisis. Another point is that, as I like to often show this graph, the UK debt is high, but by historical standards, it's been much higher. So although debt is around 100% of GDP and will definitely increase significantly in the coming years, it has been worse in the past without default. Although I could say that in the Napoleonic times, it caused a lot of inflation as the government partly monetized the debt. In the First World War, we also saw inflation. And in the Second World War, the UK did actually get quite close to default. And it was only a big loan from the Americans after the Second World War that helped us to stabilise the situation. Now, this is why, at least in the short and medium term, the UK is not at risk of an imminent default or crisis or anything like that. However, that doesn't mean we're not still facing a very serious situation, because this is an unprecedented rise in borrowing, and markets have strongly indicated that they don't like it. They don't think much of the UK's long-term economic plans. Why is that? Well, first of all, this tax giveaway is going to do very little to increase economic growth. As you know, in recent years, the UK's growth performance has been very poor. We've had low productivity, low investment, low technological take-up, and this has meant that the average growth rate has really fallen behind the post-war trend rate. But cutting tax for high earners is going to do very little, if anything, to solve this. You can see here how, despite high income earners gaining quite a bit of extra money from this budget, many on the lower income deciles are actually still worse off. So we have a strange situation that when energy prices rise 25% in October, when interest rates go up for many business, many households and firms will still feel tremendous financial pressure. So they will keep cutting back on spending. High income earners, I'd like to just highlight a comment here from the Financial Times. Very interesting. The reader is mentioning the private wealth versus public wealth. But also what's interesting is he says that the tax cut means more money in the bank. And that highlights an issue about the low marginal propensity to consume of high earners. If you're a millionaire and you get a tax cut, you tend to save it. Perhaps you want to save up for private healthcare if you don't trust the NHS will be able to give you a doctor. And this is why the big fiscal expansion is a real wasted opportunity, because if the tax cuts have been targeted on low incomes or universal credit, you'd had a much bigger increase in demand, and it would have had a bigger effect on growth. Also, in the longer term, what matters is not so much demand, but the supply side of the economy. And corporation tax cuts are a very weak way to try to increase investment. A much better solution would have been for the government to invest in green technologies, build renewable energy, pay to insulate homes to reduce future energy demand. Because there's another big issue facing the UK, which means the situation is going to be very serious. And that is, not only do we have large borrowing, but also a very large current account deficit. This has worsened in recent years, but this winter is expected to worsen even more because the price of gas is going up. So the value of our energy imports is going to increase. And demand is very inelastic for gas and oil. So when the price goes up, we have to pay more. What this does is it will worsen the current account deficit. And typically, to reduce this current account deficit, you would need a depreciation in sterling and lower spending on imports. The fiscal expansion will kind of delay that because it pumps up demand for imports. But the problem is that when you've got a falling sterling, current account deficit and more borrowing, it's kind of an unwelcome combination of these three goals. Because while sterling falls, this only serves to increase the price of imports, increase oil prices, increase gas prices, and this creates more inflation. And so therefore, despite the fiscal expansion, the Bank of England is under tremendous pressure to raise interest rates. Markets now predict interest rates of around 5.5%, which would be very damaging given how people have got so used to very low interest rates. So unfortunately, markets are not confident that the tax giveaways will do anything to improve economic growth, because this really depends upon demographic factors, investment, technological change, and this has not been addressed by the mini budget. Also, the budget is a real missed opportunity, because if debt is on an unsustainable path as it's likely to appear, this will constrain future government actions, and it may well require higher taxes, lower spending in the future. So overall, the UK is not at risk of an imminent debt crisis, like for example Greece in 2012 or Argentina recently. Nevertheless, it is quite a serious situation, and there's very much strong downward pressure on sterling because the market expectations for the UK economy have deteriorated quite significantly. One important thing about UK government borrowing is that there was many years where the UK could borrow at very low interest rates. The demand for buying bonds was very high. And you can see here that as borrowing increased in the post-financial crash, no matter how much borrowing increased, yields fell. That suggests austerity was unnecessary because there was a strong demand for buying bonds. But the situation now is very different because inflation is rising, interest rates are rising. So the cost of servicing debt is increasing quite dramatically. And one forecast suggested that the cost of UK debt interest payments may rise £35 billion more than expected because of rising gilt yields. And the UK now has many index-linked bonds, which it sold recently. But this will increase the UK debt interest payments because the higher inflation is, the more that the UK has to pay on interest payments. In the period after the great financial crisis, many economists were saying, don't worry about the debt. With lower interest rates, it's more important to target full employment, and it's good to borrow to invest to finance long-term infrastructure spending. But that argument has been kind of flipped on its head, because nowadays the situation is very different. We have rising inflation and rising bond yields. So the same motivation to borrow at low interest rates is not there. And this is why debt becomes much more important than it was, say, 5 years ago. Because 5 years ago, the Bank of England were, in a way, monetizing debt. They were pursuing quantitative easing, buying bonds from created money. But now we can't do that. We can't rely on monetization unless we want to risk runaway inflation and a real crisis. So we're reaching a situation where there are much more serious constraints on government borrowing than there were 5 years ago. So when people say you can never default with your own currency, that's not quite true, because you can definitely have a partial default where the government inflates away the debt and savings of its citizens, like it did to some extent in the 1970s when inflation was unexpectedly high. I don't expect a complete collapse of sterling or complete collapse of the UK government market, but it's quite disappointing to see such a missed opportunity that we're borrowing to fund tax cuts for big corporations and high income earners, and will be very limited return, especially in the long term. It's such a shame the government didn't take the opportunity to borrow to invest in many worthwhile public sector investment projects, like trying to reduce our demand for importing energy, insulating homes better, more renewable energy. All this could make the UK self-sufficient in energy and reduce the cost of imports, not just now, but very much in the future. And that would be a better long-term policy, not just for the economy, but also for the environment. So I hope you enjoyed this video, and if you like it, please give it a thumbs up and subscribe to the channel. I'll have lots more videos coming out soon, and if you have any questions, feel free to ask.